A very good morning to everyone. I'm Magdalene from Itus, and I'm delighted to welcome you all to our second quarter investor call 2022. I hope you are doing well, and I thank you all so much for taking the time out to be a part of the call on a Saturday morning. So our focus today will be on our performance in the previous quarter and how we look at the market in the current times. Naveen Chandramohan, our founder and fund manager, would brief us on the same. After which we will have the Q&A session, and Ajit would run us through it. Over to you, Naveen.
Thanks, Magdalene, and thank you to everyone who've taken the time out on a Saturday morning to attend the call. Through this conversation, I would look forward to interacting with you in a lot more detail. So as we move ahead in our quarterly call, right, we always start our call by summarizing how we ended the previous call. So we started off with we ended the last quarter call with 5 salient features, as I call it. The first aspect being the portfolio health has been at its best shape since inception. And in this call, I'll define what that means. A lot of things have happened from a global market perspective in the last 2 years, be it in terms of COVID, the risk of war, resulting in supply chain disruptions. And these have actually benefited the health of our portfolio. And again, I'll define what that means and how we measure this. We continue to believe India being the best geography for risk deployment today. And I'll highlight why I maintain this stance as we speak. Bottom-up stock picking will continue to be the biggest driver of portfolio returns. And we also ended the call by saying the risk of inflation does not look as though it's transitory. And today the world seems to be acknowledging that and pricing risk accordingly from where we stand today. Right. So in today's call, we'll walk you through our performance, an update on the strategy. We'll give you our perspective of how we look at US markets, because end of the day, from a top-down perspective, what happens in the US does matter to India. We then take a sneak peek into what we are seeing on the ground in terms of Indian macro, and finally, how do we translate that into our own portfolios today, where we'll address things around risk and portfolio construction. So starting off with the performance. So this tape, many of us have asked us, can you compare your returns to the mid cap and the small cap and the multi cap? And I've always maintained that Nifty is the best performing index since inception. And more than performance, I would also like to highlight the fact that it's the most consistent performance index since inception of the fund. And hence we would benchmark ourselves to Nifty. But for those who are interested, you would look at our portfolio across all the indices. So as you can see, the first half of 2022, Jan to June, has been a bit of an underperformance of our strategy, and I'll explain why and how do we see that from here. Though since inception, we've had a healthy outperformance across all indices net of fees, right? So if you look at it, irrespective of what index you take, despite this year's underperformance, our portfolio has performed strongly across years. So we'll take you through this performance. We'll take you through where this underperformance is coming from and how do we think about this. So if you look at it from a slightly zoomed out perspective rather than a 6-month perspective, 1 rupee invested in the fund would roughly be 2.62 as far as an investor return is concerned post fees, as against Nifty, which is at 1.93, and that's where the outperformance of close to 65% plus comes through, right? And that's what is materially reflected in the IRR, where we have outperformed the Nifty by close to 7% year to inception to date. Now, if you go into the granular aspect of our portfolio and what actually happened, so what we have done is broken down the retractors as well as the gainers. So talking about the gainers, our portfolio is positioned across 7 broad themes, and I'll highlight each of those themes in greater detail. In this slide, I'll just take you through the stocks, what is causing a deterioration and what is causing a healthy outperformance. One of our largest exposures is a company called Sumitomo Chemicals, which is an agri-chemicals company, which continues to perform fairly well. We also have exposure across Ahluwalia Contracts, which is a contracting company in the infrastructure space. Balakrishna Industries, which is a B2B tire manufacturing company, and one of the best globally as well from a margin perspective and how it has scaled up. And finally, a recent position that we took in a diagnostics company around what happened over the last 6 to 8 months. Now, coming to our detractors, it's nature of the markets that our best performing stocks are causing underperformance. Best performing stocks of last year have caused underperformance this year. The top two stocks that have caused a big detraction is L&T Technology Services and IEX. I'll cover both of this independently. So if you look at it, almost 50% of our drawdowns for this year have come from two stocks. Now, L&T Technology Services from the peak is, or rather from Jan 1st, 2022 to now has fallen almost 40%. Right now, the March quarter earnings that has come out saw its highest ever revenues, highest ever order book, and highest ever margins. So when a company in the IT space is effectively come out with robust earnings, one could argue that the valuation was a bit high on the higher side. If you talk about a 12-month trading multiple, back in December, it was priced at a multiple of around mid 50s, and today that has contracted to low to mid 30s. Right? So there has been a big derating on this particular stock in the mid-cap IT space. Now, what could the narrative be considering the June quarter numbers have not come out? So you've seen Accenture come out with earnings, you've seen TCS come out with earnings yesterday. There is margin pressure across the board for IT companies as employee costs have gone up. But the bigger concern, the narrative that the market is basically telling you is if US goes into recession, then the B2B contracts that companies like L&T Technology Services are gaining could contract. So whatever you assumed as your earnings growth, that could be at risk. So that is the narrative that the market is presenting in front of us. Now, as we see things on the ground as well as talking to the companies, I think the risk for this to materialize is a lot more in SaaS driven companies where companies actually spend on digitization from a workforce perspective rather than companies which are spending on engineering R&D, which is where L&T Technology Services fits the bill for us. So at this stage, we would not be overly concerned around the price action. We would want to look at normalization of earnings over the next 2 to 4 quarters and see what actually happens rather than reacting to it. So we're not doing anything to our position as we speak. It's a bit premature to react just because the price of the stock is falling. The second company that I wanted to briefly cover is Indian Energy Exchange. Again, one of our companies that was our best performers in 2021. It happens to be our top 5 detractors in 2022. Here again, there are two forces at play. If you go back to how IEX makes its revenues, it makes its revenues on the number of contracts. Unlike any other exchange like an NSE or a BSE or an MCX, which makes its revenue on the volume that is traded on the exchange. So over the last 6 months, as electricity prices have almost doubled on the exchange, the number of contracts that are traded on a high base has almost dropped by around 10%. The second risk that the market is also a bit wary about is the addition of 2 other exchanges that is coming through from a regulatory perspective. So the narrative has changed from IEX being a monopoly to 2 other exchanges that have got regulatory approval, one backed by PXIL and ICICI Bank, sorry, PTC and ICICI Bank, and that could potentially see market share move away from IEX into new exchanges. I think again, IEX having been in the market for almost 13 years, most of the large companies in India on the platform, I think an exchange is a very, very sticky business. You've seen NSE and BSE compete for market share for a good part of 25 years. There is a reason that NSE still commands 94% of the market share today. So it's a bit premature to say just because a new exchange is starting, market share will move away. But the market has repriced that risk. Again, for us, while the June quarter numbers, we expect a 10% contraction in top line, we still believe that the margins of IEX are going to be robust. The return on capital of the company is north of 65%. We don't see that at risk immediately. So while the company has given us a drawdown, again, we're not, you would see this company being in all the new portfolios as well. We're not trimmed down our stake in this position because the price, just because the price is falling. So coming back into what we did in the quarter, some of the new positions that we actually took into the portfolio as we speak. We bought Balkrishna Industries back into the portfolio. This has been a stock that we owned in 2017 and 18 and 19. And currently with the auto cycle, as well as the fact that Balkrishna Industries is the market leader at a global level, and the fact that competition is being taken out because of pricing pressure, and because Balkrishna Industries EBITDA margin is almost close to 3x the next competitor globally. They have a robust expansion plan set. The fact that they backward integrated into carbon black, which is their raw material, is benefiting them, as a result of which we believe that the valuation is still reasonable, and we expect a good growth on the company over the next 2 to 4 years. Diagnostics, we took a starter position in Dr. Lal Path Labs, which is the market leader. Obviously, diagnostics as an industry has been hurt over the last 6 to 8 months. Every company in the space, in the listed space, is down almost 50 to 60%. There is a reason for that, because the market gave a multiple to these businesses on COVID plus revenues. And when that COVID plus revenue started going to zero, then the market realized that they had repriced these companies fairly aggressively. So most of the stocks are down 50 to 60%. And I would think, I would not want to compare the revenues or the price action 6 months back to today, because I still believe that the price action 6 months back didn't make much sense. The question is, now that the prices have corrected, is there margin of safety? For which there is another risk that is impending in the market, which is e-commerce players like PharmEC and 1MG and the new, or even some of the pharma companies entering into the diagnostic space and creating a lot of significant pricing pressure. If you look at open newspapers today, there is advertisements running on the front page for a checkup run at 100 rupees. It used to be 700 rupees, saying that there's an 80% discount. Our view on that is diagnostics being, if you think about it yourself, you go to a diagnostics lab for 2 reasons: for the quality of the test, and maybe you go twice a year, right? So this is not an industry that that works on discounting. Very similar. On when you buy food online or delivery online, you might look for the cheapest prices. But when it's a diagnostics lab that you're talking about, it's not purely on the fact of who offers the cheapest price, because service matters, localization matters, being close to your home matters. So while there is near-term pressure, we certainly believe that the market leaders who have protected their margins for the last 12 years are the best equipped to handle this, and hence we own Dr. Lal Path Labs here. And the last company is a micro cap company called RACL Geartech. Very interesting company. It's an extremely small market cap oriented company. Market cap would be 600 crores. This is the only gear company in India which continues to have an EBIT margin of north of 20%. This is unheard of for a gear company. The reason primarily being they are a niche gear manufacturing company, supplying to the likes of BMW, Porsche, Volvo, in the two-wheeler segment, in the four-wheeler segment, Kubota, which is a Japanese tractor manufacturing company. And they are also now going into EV. They have the ability to actually manufacture. Just because there is a transition into EV doesn't mean you stop using gears. In fact, it's quite the contrary, where the torque as well as the precision requirement for EV is that much higher. So it's not like a traditional gear manufacturing company can transition into into EV. In fact, if you look back, many people may have forgotten this, but the first EV manufacturer in India was a company called Reva back in 2010. Right, Reva didn't take off because that was too early for India to transition into EV, and I still think it is even today. But my view aside, the gear manufacturing for Reva back then happened to be RACL Geartech. So it's a small niche manufacturing company with good margins and a quality promoter. There is a risk, like any micro cap, there is a risk because a lot of the expansions being done today is being funded through debt. However, the expansions are being done on the back of a strong order book. So unless and until we go through a sustained recession where the order book contracts, that risk on the balance sheet is not material. And being a micro cap as well, we've obviously managed the risk through the position sizing that we would own in such a company as well. Moving on from a strategy and a portfolio construct perspective, we continue to maintain a non-model portfolio that will not change. What that means is you would find healthy cash balances across all our portfolios. In fact, many of our clients and many of our partners, our business development team would be talking to them on a regular basis around adding cash to the portfolio today. And we continue to be extremely selective in deploying capital on a bottoms-up stocks selection basis. If you look at the portfolio, you will find a common theme. The common theme in our portfolio is owning businesses which have pricing power. Now, why does this matter? If you had read the letter that was sent across to you, we would have spoken about in the last 1.5 years, how has the gross margin of our portfolio expanded by 4.5%. Now, just to put it into context in the environment that we are in, where cost of labor, cost of raw materials, as well as cost of finished goods as a result has gone up in many cases by 30 to 40%. If you think about gross profit margin expanding, you will understand the quality of such companies, because these are businesses that have the ability to translate many of their finished good products into the end consumer, be it a B2B or a B2C, as a result of which many of them managing their inventories well means this translates into cash flow growth. And as a result of which they are able to expand their market share during a difficult time. There are other kinds of companies which are growing their revenues at the cost of margins, at the cost of gross profit margins as well, at the cost of a slightly deteriorated balance sheet. We want to be cautious on such companies. And if you look at the portfolio at the overall market cap basis, it does look like our average market cap looks like a mid-ish cap portfolio. It's around 48,000 crores, but we have a fair mix between large, mid, and small today. Right? And the last aspect, which very few people talk about, is you would not want to sacrifice liquidity at all in our portfolio. And we continuously measure that around how quickly it is to liquidate our positions. And what kind of liquidity are we sacrificing if we go down the market cap curve in terms of investment? And that's been a premise of importance for us since starting the fund. So I started off by giving you an update on the performance, walked you through some of the detractors as well as the companies that have done well for us this year. Moved on to updates on the portfolio in the last quarter, along with a portfolio strategy at the overall construct level. Now I'm going to slightly zoom out a bit and talk about what our views on the US and what is actually happening, and then move on to our views on India and what is actually happening on the ground. So the common consensus that, in fact, the last few months have been asked the question pretty often, what is my view on the market and have we made a bottom, right? And I think this question is extremely irrelevant, because it's like basically saying, do I have the ability to predict the future? And the honest answer is I don't, right? However, I have a certain view depending on what I am seeing on the ground. Now, most of the HNI investors in India, the biggest theme for them is to invest in the US. And that has been aggravated in India, primarily because mutual funds as well as global funds have come into India and said, look at US returns. They have been extremely strong in the last 10 years. You're missing out in the name of diversification. I think the nice story has been laid out, but it's important to understand the context of the story. One of the primary reasons when a market does well, when someone says view on the market is a top-down view, which automatically has a function of the liquidity that is in the system. And if you look at the liquidity in the system in the US, this graph shows you the Fed balance sheet over the last 10 years, right? Roughly $1 trillion around the start of the GFC, which seems like a distant memory, to almost $8.6 trillion as we speak. Now, the magnitude of the increase is one aspect, but it's really important to understand over the last 1.5 years, we have doubled the size of the US balance sheet as a response to COVID. And we are, as an investor community, as well as a global economy, realizing that we need to normalize into a pre-COVID world. And one of the aspects of normalization also means taking liquidity out of the system. Now, while we talk about interest rates and inflation, that is one aspect of the curve, which is a risk, which is what the market is pricing in today. No one is paying attention on the fact of when is Fed going to withdraw liquidity. Even today, Fed has not stopped the asset purchases. They have reduced the size of the asset purchases. So to me, this has to normalize. When is anyone's guess? Interest rate increase is one aspect of the normalization. Second is additional asset purchases has to come down. And this is a big risk that I see in the US. I personally see over the next 3 to 5 years, Fed has to normalize the balance sheet. It has to come from around $8.6 trillion today back to around $4 trillion, at least even if you go back to the pre-COVID world. It does not mean it has to, they have to do it in 3 months or 6 months or 12 months. It's a 3 to 5 year phenomenon. What that means is when you are investing in a market, it's important to pay attention to this to see what kind of liquidity is in the market. So, am I comfortable with risk in the US? I have been voicing my risk vehemently for a good part of 7 months. I am not. I still think risk will emanate from the US. And how do we translate that into India? I'll cover that. Now, this is a chart that I just wanted to highlight around policy rate in the US, as well as the CPI rate in the US, which is what the Fed, if you read the Fed commentary that comes out, Fed basically benchmarks its interest rate on the backward looking CPI rate. Now, I'm not going to comment about the flaws of this policy. This is what Fed has chosen to do, so we'll have to live with it, right? Now, obviously, you can see a stark dichotomy between the policy rate today as well as the CPI rate that has come out in the last print, which is what market experts in India have basically said. Fed has already given the path of 1.2 going to 3 by March 2023. Commodity prices are falling, as a result of which this CPI rate looks inflated. 8 might fall to 6. I think my personal view, if you ask me, I see the next 2 prints as north of 8, not lower than 8. And it might normalize after that. Now, equity markets are a forward-looking mechanism, so they price in a lot of this risk already, and which is what you have seen from a sell-off in the US. And I think we are in the mid to late stages of a supply-demand normalization from an interest rate perspective. While each of them have a view on when it would normalize, I think over the next 1 or 2 quarters, this should normalize. So I don't see this as a big risk as we speak. I see the liquidity aspect as a bigger risk. And once Fed starts announcing, that is when the market is going to start pricing in that risk, right? So that's my broad view on the risk on the US and why I continue to be cautious. In fact, I continue to think volatility will emanate from the US over the course of the next 3 to 4 quarters. Now, obviously, if US has a problem, we get worried in India. That's how we are. And I think there are ramifications around India as an economy has changed. Dynamics on the ground have actually changed. And it's important to realize that problems in the US doesn't mean that we have to sell off to the same magnitude, though we have ramifications. Now, first thing that we obviously worry about is oil prices being too high. It's important to realize that today, with our fiscal deficit as well as forex reserves of almost 20% of our GDP, even at $120, the so-called fiscal deficit, which we had budgeted at 6.4%, looks like it can go to 6.7%. It doesn't look like a big balance sheet deterioration. Second is, if you look at, just as you do a P&L of a company, if you look at the first half of the slide, talks about the P&L of the country, which is the revenues that it earns and where it earns them from. The bottom half talks about, the top half talks about where they're going to be spending. Bottom half talks about the revenues that they are earning. So if you look at it, still it is offsetting itself even at a much higher oil price, right? So you don't have a huge deficit that you are running, even if oil prices goes and settles at $120, which it's not, but let's just assume that it does. Second thing, if you look at where is government actually spending, the Indian government or RBI did not expand its balance sheet in an aggressive way by printing money. In fact, we've been borrowing money from the capital markets as a government, because the capital markets have been open. And a lot of the spends that you are seeing has gone into three areas. If you look at the rural spend growth, it's expanded on a consistent basis. And it's gone into areas which have actually been beneficial from a country at large, which is basically roads, drinking water, as well as Swachh Bharat scheme. So that's where the central's focus has been, and which has been positive for the government from a recovery perspective. What is this translated to in India from a liquidity perspective? If you look at the things that are highlighted in yellow, between COVID to now, there has been a significant increase in the liquidity on the ground from a CASA perspective, right? So why is this important? The CASA that the banks own has almost jumped up by almost 8.8 trillion in rupee terms in the last 12 months, despite the pandemic hitting. What that means is banks are sitting on an aggressive liquidity buffer as we speak. So the liquidity is not injected in the system through money printing, it is injected in the system through CASA. And as a result of which, market borrowings, while it has gone up from the open market system, right? Now, CASA coming into the economy is good. It needs to flow through in the form of actual loans. And if you look at the loan growth on an incremental basis, it's come through in three forms. The significant contributors have come from roads in the infra space, which is highlighted in the table at the bottom, around 18.4% growth, as well as personal growth, where the loans have actually gone up in a significant way. So obviously, just because lending has gone up doesn't mean it is beneficial to the economy, but it's important to understand that both the government as well as the company balance sheet have been cleaned up in the last 4 years. So when the cleanup has actually happened and at the same time borrowings are increased, it generally results in actual GDP growth. Now, the same thing can reverse if it leads to an aggressive cycle of of lending growth followed by a demand slowing down. We are not in that stage of the economy yet, right? So the last part of what people immediately talk about around where people get concerned is the FII outflows, right? Because in the last 25 years, we still seem to believe that the Indian market is actually held up, or rather it's dominated because of FII flows. And I continue to maintain they are just one small part of the larger picture. So when people or analyst community or the narrative at large basically says, oh my God, 665 billion dollars have actually flown out of India, which is almost 2x of what happened in GFC. It's important to put that number in context. The number in context is also to realize that Indian market cap has almost gone up 10x as well, right? So effectively, uh, over the last 20 years. So as a percentage of the overall Indian market cap, what you have is FII ownership has actually come down by 1%. So if you look at the FII ownership of India, or as a function of the overall market cap of India, it's oscillated anywhere between 18.5% on the lower side to 21.5% on the higher side. So the 21.5% is what you saw in September 2021. And today, what you're seeing is closer to a 20.2%. So, is that cause for concern today? Not really, because they are just normalizing through this outflow. You have normalized their exposure back to me. So, to panic on the fact that, oh my God, FII outflows are happening at an aggressive rate, because if you look at the total number, it looks huge. But as a percentage, it really is not. It's pretty much in sync with any sell-off that you have seen in the past. So here again, I don't think you look at liquidity and panic on the ground in terms of what FIIs are doing. Now, basically, just to zoom back in today, right, into the portfolio, I started off by basically giving you my perspective and our view on the US. How do we see the same thing in India? The two economies seem to be diverging from a fundamental perspective and a liquidity perspective. I am continue to be bearish in the US. I continue to be optimistic in India. What does that mean? Effectively saying that any volatility that you see is a buying opportunity. I still don't think that you can just go and buy aggressively in the market just because the market is down 10%. I still think there is risk in the system from a liquidity perspective that will translate into volatility on the micro, and that's what we would want to use in order to add capital back into the market. So that's how we think about risk from a holistic perspective. Now, coming back into the portfolio around what we are doing, broadly from a top-down perspective, we are invested across 7 themes. 7 themes being there is lending financials, there is non-lending financials. Non-lending financials are effectively companies which do not have leverage on their books, right? So it could be an insurance company. We used to own AMCs. Today we have zero risk in AMCs. Auto ancillaries, which is manufacturing companies, B2B manufacturing companies, especially in the chemicals or specialty chemicals business, pharma, IT services, and consumer brands. Again, the common theme in our portfolio is to own those companies which are gaining market share and growing their margins. Because end of the day, if the inflationary theme is here to stay, you want businesses which have pricing power and at the same time who don't lose market share around pricing power. It's no point of raising prices and losing market share. Those are again not fundamentally strong companies. And lastly, this is something that we have been underweight for a good part of 1 year. While financials today look like they are cheap, we continue to study them around saying, do they deserve more of an exposure in our portfolio? But we continue to be underweight financials because we feel that there are better pockets of ownership of investment, and at the same time, capex across sectors is still not flowing through. Capex is flowing through in specific sectors and specific parts of the supply chain. So end of the day, to structurally own banks doesn't add too much of value as far as we are concerned. Final thoughts before winding up the presentation from our side. We continue to believe the portfolio health is at its best shape, though the first half has seen drawdowns. Higher inflationary regime has benefited our portfolio. Why do I say that? Because you have companies today who have grown their earnings, grown their market share at higher prices. So if inflation does normalize itself, which I'm not saying when it will, but when it does, you will see these margins accrue back to these kind of companies. India continues to be the best region for risk for deploying capital, and risk continues to emanate from the US. And I don't think that the risk in the US is done, and people who basically say they're calling for a bottom, I'm not sure how you can call for a bottom. You might get bear market rallies. That's par for the course in the markets, but end of the day, we would want to be using those sell-offs in order to increase our exposure of equities in the overall portfolio that we construct. So I'd like to end this call here and open the floor to questions. Ajit would run the Q&A for us. Ajit, would you be able to take over?
Yes, Naveen. Naveen, thank you for the update. Investors who have questions can feel free to type in your questions in the chat button. The identity of investors are protected as the questions are only available to the organizers. So, Naveen, I have a question here. Our portfolio has been moving from large to mid to small, and we is the portfolio shifting? And there's a second point to it: are we buying good businesses at a higher valuation?
Understood. So, two parts to this question. We don't think about the portfolio as large or mid or small. Right? From a risk management perspective, internally, the way the team looks at risk is from two aspects. Fundamentally, are we owning businesses whose market share is growing? Are we owning businesses whose margins are expanding? And are we owning businesses whose cash flows keep growing? Now, in our country, we have multiple sectors where the best or the largest business in that sector happens to be a mid or a small cap, right? Now, if I give you examples, Balakrishna Industries, I cannot find an equivalent of Balakrishna Industries because it is a mid cap. And the first time we bought it, it was a small cap. Similarly, Indian Energy Exchange is a small cap and it's the largest. So we don't think about saying, okay, today large cap is cheap, I need to move to large cap, or today mid cap is cheap, I need to move to mid cap. We think about it from a bottoms up company perspective. So large, mid, and small happen to be consequences of the companies that we own, rather than the conscious decision to say, I need to own large, or I need to own mid, or I need to own small. If that's how we thought about risk, you would see us running three different strategies. From day one, we have maintained that the reason we run a multi-cap strategy is because we are buying growth, not buying market caps, which means there is a process around our philosophy rather than saying, if you are a large cap investor, come here. If you are a mid cap investor, come here. Or if you're a small cap investor, come here. Right? I don't think market should function that way, though we do, but that's not how I think we do at Itus. Second is, if you look back with the benefit of hindsight, did we buy certain companies at a high valuation? The answer is yes. Right now, at that point of time, so in the previous call, we had highlighted three aspects: the base position, starting position, as well as the fully sized position. This is how you would see three position sizes at Itus. When we find unique businesses with good promoter quality who have not diluted too much of capital in the past, then we would look at owning such businesses with a startup position. Yes, two of those businesses have given us drawdowns. The way we think about this is it was risk managed with a startup position in mind. So even if we get it wrong, you will not lose too much of money at an overall portfolio level. So that's how we think about risk. With the benefit of hindsight, if I was to go back and say that, yes, did we buy it at a slightly higher valuation than where we would have liked, the answer is yes.
Thank you, Naveen, for that. Naveen, how do you, or when do you think the market would turn?
So again, I tried to answer that question through the presentation, right? The easiest answer that I can give is I don't know, right? If someone tells you when the market is turning, then I think they have an alternate profession, which is not ours, which is called an astrologer. So unfortunately, I don't know when the market is going to turn. But if you ask me, am I comfortable around just buying risk? So the two aspects to this question, right? Let me rethink the way to answer this question and provide the best answer possible. If you're going to buy market risk, the best way to buy market risk is ETFs. So what you are buying when you buy a market is you're buying beta. What that means is that the market goes up 16%, you also go up 16%, everyone is happy, you've made money. Through an actively managed fund at Itus, you are potentially buying alpha and our ability to stock pick, right? Now, here, we are not buying companies because we have a view on whether the market is going up or down. We are buying companies because we believe these are good quality businesses which are growing market share and pricing power, right? So on the one hand, if I look at the liquidity system and how it needs to come off and how supply demand needs to get normalized, I don't think market has made its bottom. Okay, this is from the US, and that's where my point of concern continues to be. Right now, can the market in the meanwhile give you a 10% or a 12% upside over the next 2 to 3 quarters on a bear market rally? The answer is yes. Right. So if you want to time the markets, you should be buying an ETF. Right. And if you want to do that, you can buy it on any correction. And I don't think anyone in their right mind should be predicting where it's a bottom and where it's a top. If you rewind back 7 months ago, everyone was basically saying that this market is going to 22,000. Today, most people are basically saying this market is going to 14,000. So what are people doing? People are extrapolating the last 3-month action and calling tops and bottoms. I don't know why we enter into such an exercise, because it's not fruitful. What is under our control, our company fundamentals, I would much rather focus on that. But I just gave you a picture on why I'm bearish the US. So if you are buying the market, you are buying short-term upside. That's not something that we are experts in. I don't know who's an expert in that, but this is our overall view of the world as we speak.
Thank you, Naveen, for it. Naveen, is it a good time to deploy money with a 5-year view?
So the short answer is yes, but the longer answer to it is, so there are two ways of deploying capital in the market, right? Either is, again, if you go into the mutual funds or ETF space, or most PMSs who fund managers who run it, they are buying tomorrow through a model portfolio. So that's not something that we've been fans of. Now, to come back to what we would do, because why are we asking for capital? Because this is the kind of market we would want to own cash into, to buy into volatility. So we would take time to deploy capital. So roughly, if you look at all our new portfolios that have been constructed, you would see a significant cash balance to the tune of 30 rupees for every 100 rupees. And we would want to maintain that to buy into volatility. If the Fed does unwind its balance sheet, or rather gives signs for it, and the US market reacts to it, that volatility is something that I would use. If the Fed doesn't give any signs of it and the narrative suddenly becomes inflation is cooling off, so we are again good and the market starts rallying, I would be cautious in deploying capital. So this is the view of the world in which we will operate from.
Naveen, there is a follow-up to that. How would you deploy funds if given today?
Sorry?
How would you deploy funds if it is given to today to you?
So like I said, for every 100 rupees, almost 60 to 70 rupees would get deployed over the course of the next 1 month, and we would maintain cash. I see the world moving in one of two ways. One, front-ended volatility, because I expect the Fed to actually be to err on the side of caution. They have got their policy horribly wrong on one side, and I think they will move to the other side and get their policy uh, even wrong, and the market might react. If the market does react, I would be extremely aggressive in deploying that capital back fully into the markets. The second possibility is Fed changing its course and basically saying that inflation is cooling off, as a result of which, yes, I have increased rates. Now we see things back to normal, and the market rejoicing that and moving up in a straight line. If I get that kind of a market, I'll continue to maintain that 30 rupees of cash into the markets. So these are the two scenarios that I foresee and how I will deploy capital.
Naveen, the last question. What is your view on HDFC Bank?
So obviously we own HDFC Bank, right? We have roughly a 5% exposure across all our clients. So that itself tells you our view. Now, HDFC Bank has had multiple headwinds in the last 2 years, right? From management change to issues around technology to issues on the ground now that they're going to face on the culture integration between the merger. Now, it's important to understand that when you have issues to a quality franchise, the valuations do get derated. So if you look at HDFC Bank's valuations over the last 12 years or even 15 years, the range of price to book that the bank trades is anywhere between 2.4 on the lower side and 4.5 on the higher side on a 12-month trailing price to book basis. Today, you're getting the bank at the lower end of the range, which is basically 2.4. So what am I basically saying? If I can't basically grow my book value, which means if my loan growth actually stalls, then effectively my book value will deteriorate further, which is not the case. Now, for material upside to come through in the short term, I think the only way this can happen is for earnings growth to follow through, because in the short term, I still see issues around the integration between the HDFC Limited and HDFC Bank. So, long story short, I still think that the bank is cheap for the growth that it generates. Do I see short-term upside? Maybe not. But from a longer-term franchise, I still think the bank offers value. Though everyone likes ICICI Bank for what Sanjay Bakshi has done, which has been phenomenal. So just to give you a perspective of how we think about the bank.
Thank you, Naveen. Nazara and Nika, are we looking to increase exposure at these levels?
No, we wouldn't increase exposure because our exposure is not just a question of whether price falls or price goes up. It's a question of what actually happens to earnings. So would want from a Nazara's perspective, its capital allocation around how it deploys. So today, Nazara has 700 crores of cash on its balance sheet and its market cap is 2,200 crores. So they would have to deploy this cash into businesses that they buy and integrate. I want to see how they do it and is the incremental capital on returns actually increasing. And for Nika, is the B2B business actually going to grow or not? So unless and until they deliver earnings on the ground, as a result of which the price, the so-called valuation normalizes, we wouldn't look to add any capital in Nazara or Nika at this stage.
Naveen, that's about it. Thank you for the questions. Maggie, you can take over.
Sure, Ajit. Thank you, Naveen and Ajit, for the Q&A session. And once again, I'd like to thank you all for taking the time out to be a part of the call. So the recording of this webinar will be made available once it's done. So I think that's it. Thank you all and have a wonderful weekend.
Thank you again for everyone's time.